I got a very good question from one of my subscribers in the comments, and he asked me the S&P 500 is up a lot year to date. We're up over 10%. We're trading at crazy high valuations. If you had a lot of cash right now, where would you deploy it? What do you believe are the best risk to reward setups in this market? Maybe it's stocks trading at 52 weeks lows, maybe stocks that are fairly valued or undervalued, or they have been flat for the last few years. Just good setups in general. And this is what I'm going to talk about today. I'm going to share 3 stocks with you that are not up a lot. Some of them are amazing companies that have been flat for the last 3 or 4 years, and I don't believe they're going to be flat for too long. And I'm going to share those ideas with you, and I really hope you enjoy it. As always, the first one is an amazing quality company that I haven't talked about in a while, and this is ASML. ASML is still flat, guys, from 2021. Relative to the market, this is really not bad at all. It was just too expensive, but now the company has grown into its overvaluation, and I don't believe it's going to remain flat forever. And I think the setup relative to the overall market for a quality company is looking really, really good for ASML on a relative basis. But if you're not familiar with ASML mainly has over a 90% market share in the patterning phase of semiconductors. So all those fabs like Taiwan Semi, Samsung, Intel, they all need the lithography machines of ASML for them to make those semiconductors. The company has pretty much a monopoly. They charge whatever they want. They pretty much have no competition. And the competition is estimated to be 10 to 15 years behind them. So this one has one of the widest moats you could have, which is research and development that doesn't only take capital, but it takes years and even decades to come up with the technology that ASML actually possesses. So I always call ASML the toll bridge to innovation. So if you're looking to bet on maybe semiconductors in general, and you're not trying to pick who's going to make the best chip, if it's AMD or NVIDIA or AVGO or whatever, if you're betting on ASML, or even if you're betting on, let's say, Taiwan Semi, you're getting exposure to the entire industry instead of trying to pick winner. You're betting on ASML, which all of them, they need the ASML machines. And you're also getting exposure to data centers, electronics, robotics, automotive. You're getting exposure to everything, all within one investment. And if you believe those will grow into the future, which Taiwan Semi told us, the AI demand, it's not stopping anytime soon, ASML should do extremely well. But this is not just a business where it's just cyclical and it's all within the cycle. They also have a business called installed base management, which is mainly their maintenance business. So after they install those machines, they need updating, they need upgrading, and they also need to be maintained. And this is more of a resilient recurring revenue business model for ASML, which has been growing double digits, and I believe it makes up 25% of the portfolio. So 75% is more cyclical, 25% is more maintenance, which is recurring revenue, and they expect it's going to grow 13% CAGR from now to 2030, which is very interesting. Now, I told you guys the stock was extremely expensive. Back in 2021, it was trading at like 50 times earnings. It was insane. Now the multiple got halved. It's trading at 27 times earnings. The average is 31. Now trading at 27. Now 27 may seem expensive, but the company almost has no stock-based compensation, almost none. So the PE ratio here is much more honest than the PE ratio of NVIDIA or even AMD, which I personally have a stake in through options, and I talk about the stock. But the management believe the stock is cheap. They've been buying stock like crazy, especially over the last few quarters. They bought back a lot of stock, and they continue to buy back a lot of stock. The company has grown earnings per share at a 22% CAGR since 2014, and I believe they will likely continue to grow 20% per year for the next 5 to 10 years from a combination of buybacks, which they've been buying 3 to 4% of the market cap per year, and then the rest should be revenue growth, should total around 20% in earnings per share growth. So I believe 27 times earnings, well below the average multiple, for 20% earnings per share growth for a company that has such a wide moat, such a competitive advantage, such pricing power, growing again 20% in earnings per share with 29% net income margins. This is really not bad at all, guys. I don't believe the company is expensive on a relative basis to the overall market. market, especially taking into consideration the chart, how the stock has been flat since 2021, and the setup in general. Now, the main risk with ASML is the China risk, because 27% of their shipments, they still go to China. And every year you have an article which says that over the next few months, China is going to have their own lithography machine and they're going to dump ASML. And that comes in every year, and there's all kind of drama, the stock goes down, but that's never the case. And there's a lot of estimates that China is still years and years behind in terms of having their own lithography technology to match ASML. But if they ever do get their capabilities, that could really hurt ASML. But for example, a few years ago, it used to be 40% of total revenues, now it's 20%. And their guidance is to 20% because a lot of fabs are opening in the United States, and that's offsetting a lot of the China demand. So overall, it's going to balance itself out. But the biggest risk is that 27% is to China, and of course, 35% is to Taiwan. And if something happened with Taiwan, but again, they still need the SML because there's no alternative for now. And there's not going to be another alternative for the next 5 to 10 years. And that's my first one. And I believe it's one of the best quality stocks for terms of a setup in this market. And I like it a lot. The second one is Adobe. Adobe is a stock that I used to hate, and I used to make a lot of bearish videos on Adobe. But very recently, I've been researching the stock more, and I'm personally considering it because it has such bad sentiment. And I've seen it before. Anytime you have a company with solid fundamentals, but such bad sentiment, like ChatGPT is going to kill Google, autonomous vehicles is going to kill Uber, I always buy those stocks and I make money with them. I don't know why. Because the stock gets so low that maybe the fact is true that ChatGPT could hurt Google, but Google gets so cheap that it more than prices in the underlying risk, and then the stock bottoms on bad news. This is how those stocks bottom. Now with Adobe, the risk is that AI is going to kill Adobe. But if I look at Adobe, I'm seeing 16 PE, I'm seeing 11% earnings per share growth, I'm seeing 97% recurring revenue, I'm seeing a 4% buyback yield. They're buying back a lot of stock. I'm seeing little net debt, and I'm seeing extremely bearish sentiment. And the stock is down 21% year to date relative to the S&P. And to me, Adobe is getting very interesting. Now, if I look at their SaaS business, 95% subscription revenue, it's going like crazy. I'm not saying Adobe being killed over here, guys. If I look at the Adobe Cloud businesses, Document Cloud is growing like crazy. Creative Cloud is going like crazy. Experience Cloud is also re-accelerating in growth. So if I'm looking at Adobe here, guys, I am not seeing a dying company. Now, if I look at revenue growth quarter on quarter, normally if a company is declining or it's really being hurt by something, you would see growth starting to decline. So far, we have not seen it with Adobe. It's mainly sentiment. I have not seen it in the income statement. And if I look at revenue growth, it's been consistent 10% from the last quarter up to December of 2022. So Adobe has kept the 10% revenue growth since 2022. So again, I am not seeing it in the number. I'm seeing it on X that it's dying from AI, but the numbers are so far showing otherwise. Now, Adobe is not just sleeping on AI. They have an AI strategy. The first one is to monetize AI within their existing portfolio, and they call it AI-influenced annual run rate, and that's generating $3.5 billion within Adobe. So they're taking the Adobe tool, they're putting AI within their own tools to enhance those tools that a lot of people use, and that's generating $3.5 billion. So it's not like people are not depending on them. People are even finding them more useful than they were because of AI. So Adobe is using AI to better its own products. The second one, it's an AI first product where it's 100% new, 100% AI. Now they started that last year in 2024. So far, it's generating 125 million in annual run rate, and they expect it to generate 250 million in annual run rate by the end of 2025. Now, from 0 to 250 in 2 years for a new product portfolio using AI, this is really not bad at all, guys. So maybe Adobe is not going to be killed by AI. Maybe Adobe will actually even benefit from AI or even be able to use AI to sustain its growth. Now, 250 million is nothing relative to the overall company, but this is still showing you that they're doing something about it. And relative to the sentiment and the multiple, it's getting interesting. Adobe used to trade at 50 times earnings. Now it's trading at 16 times earnings. From 50 times to 16 times, the stock is dropping like a rock. And that was, again, one of the best, highest quality software companies to own. Now no one wants to own it. For me, I'm starting to get interested. So at 16 times earnings, it's growing earnings still around 12, 13%. Now it's going to be higher because they're buying back stock. I mean, the stock is too cheap to ignore. And I have to say, I would say it's one of the best setups in this market relative to the S&P, relative to other stocks. My favorite one is so far ASML. Adobe is more for risk takers that want to research the stock more and like buying stocks with bad sentiment. But for me, I'm still researching the AI impact. But I talked with a lot of smart people and they told me that they're actually using Adobe more. They're not quitting on Adobe because of AI. So to me, this is very, very interesting. Now, the last one, which is more of my style of investment, is OTIS. OTIS is a stock that I used to own. I talked about it like 2 weeks ago, around $84. It's still trading at 87. The stock is down 12%, which is very interesting. Year to date, it's also down 5%. So it's an interesting setup relative to the S&P. OTIS, maybe you went to an elevator, maybe in Dubai, in some building in Dubai, maybe in Indiana, maybe in China, maybe anywhere around the world. Maybe you've seen OTIS in the elevator. So OTIS installs those elevators and they maintain them. One of the best recurring revenue business models in the world. Pretty amazing stuff. Now, OTIS is suffering a lot in terms of orders and backlogs, and it's mainly because of China. So there's a lot of slowdowns in China. They had a bubble in their market, and it's hurting OTIS. Now, if you look at OTIS, their orders only grew 4%, but OTIS ex China grew 14%. This is very, very interesting. And the biggest one is, again, China, but over the last few years, they've been less and less dependent on China. So it was 2.5 billion, then it's 2.4, then it's 1.9. And I believe ultimately they're going to eventually sell their China business, if I had to guess. Now they're saying they're going to monetize the operations and stabilize the slowdown in China. I believe they will likely sell some businesses, and I would not be surprised if they exit China. And if they do exit China, you're going to see a completely different company, much more efficient, much better performing stock. It barely delivered 12% a year, even though the underlying business is so strong, excluding China. So OTIS is nearing an inflection point. It's looking very, very interesting. If you look at the equipment segment, this is not the best segment. And again, it's being hurt by China. Organic sales declined 10% and operating profit is only 5.3%. It's not the best one. Now, the best segment of OTIS is mainly maintenance. This is where the money is made. This is where the high margins are. They have 25% operating profits because once they install those elevators, normally they have very long-term contracts with OTIS to come in and maintain the elevators. And if you have an emergency, you're going to pay very high prices for OTIS. I know a lot of building owners where they pay a lot of money for OTIS to do basic things, change batteries on some kind of monitor, and they charge them a few $100s for nothing, or sometimes thousands of dollars for nothing. And sometimes for certain parts, you have to use OTIS. You cannot use another company. So they have a monopoly once they install those elevators, and it's a beautiful, beautiful, beautiful business model. 25% margin. This is 89% of operating profit. Only 11% is in new equipment, 89% in services. So this is, again, an amazing, one of the best business models you could have in the market. Now it's trading at 21 times earnings. The average is 24 times earnings, so it's trading well below the average. The stock, again, is down 11% on the months, and the company used to grow earnings per share around 10-11%. It's expected to get back to 10-11%, and they also have a 1.5% dividend. So for me personally, I would expect a 12% annual return on OTIS, excluding a multiple expansion. With a multiple expansion back to the average, I would guess it's around 13, 14, 15%, depending on what they do with their China operations. But I think even in the short term, as more of a trade, I think OTIS actually looks really good. But if you're a long-term investor, it's one of the most solid companies in the market, especially relative to the S&P 500 and the valuations and everything else. So I recently talked about a growth stock, and I know it's a little bit more expensive. And you guys told me to talk about some value stocks and stocks that you believe are good setups that are actually down. And those are three stocks that I like very much. The first one being ASML. I think it's the best one. Second one is Adobe, more of risk taking with this one. Last one is OTIS. It's one of the best operations and is trading at a discount relative to the average. So that's my video for today. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.